Very good morning. This presentation is brought to you by Eurozone International with a mission to leverage knowledge worldwide. The topic being covered is US Fed rate cuts, what the US achieved and what the world can learn. Ladies and gentlemen, the US Federal Reserve's recent rate cut was driven by an urgent need to stimulate the economy amidst slowing growth, softening inflation, and increasing global uncertainty. While the intent was to boost investment, consumer spending, and economic confidence, the results have been mixed. A global comparison of the US strategy and other major economies like the Eurozone, Japan, China, India, Brazil, and South Africa shows a broad range of outcomes and underscores therefore the key lessons about the limitations of monetary policy alone in addressing deep-rooted economic challenges. We will look at 4 objectives which the Fed had kept in mind before announcing the rate cut. Objective 1 was stimulating consumer spending and investment. What was the outcome? The outcome has been partial success. The Fed aimed to lower borrowing costs to encourage more consumer spending and business investment. US mortgage rates fell, boosting home sales by 5.4%, while capital investment in technology saw a 2% rise. However, the broader retail and manufacturing sectors experienced only modest improvements, with investment increasing by just 1% and 0.3% respectively. Consumer confidence showed only a slight uptick of 0.6%, reflecting ongoing economic uncertainty. Let us compare this with other examples in major economies. India's experience. The Reserve Bank of India followed a similar path, cutting rates to re-energize credit growth. While housing loans saw an 8% surge, private investment increased by only 1.2%, held back by inflation at 6.7% and weak consumer demand. This highlights the limitations of monetary policy when deeper structural issues such as inflation and low consumer confidence persist. Brazil's example can also be taken. Brazil, which aggressively cut rates to stimulate the economy, saw more positive effects in housing and in exports. However, overall growth remained sluggish at 2.9% and inflation surged to 7.2%. The disconnect between consumer confidence and inflation control hindered further economic progress. What's the lesson from this attempt? The US, India, and Brazil demonstrate that rate cuts can spur credit-sensitive sectors like housing, but have limited effects on broader economic growth unless paired with other structural reforms to control inflation and improve business sentiment. Let us look at the second objective which Fed had kept in mind before announcing the rate cut. This is containing inflationary pressures. What has been the outcome? It is mixed. The rate cut initially stabilized inflation in the US, keeping it at 0.4%, but inflationary pressures are expected to increase it to 1.8% next year as consumer activity picks up. This signals that while monetary easing can temporarily contain inflation, it risks reigniting inflationary pressures if the economy overheats. There are examples to look at. In the Eurozone, where the European Central Bank adopted negative interest rates to combat deflation, inflation remains below the 2% target and growth has stagnated at 0.8%. Japan has faced similar challenges with years of ultra-low interest rates, failing to achieve sustained inflation or robust economic growth. Both regions show the difficulty in using monetary policy to generate inflation in stagnant economies. Brazil example can also be taken. Brazil's rate cuts led to a surge in inflation from 5% to 7.2%, largely due to rising import costs and energy prices. The inflationary spike has become a key concern, eroding the benefits of lower borrowing costs and complicating future economic management. What's the lesson from this objective of containing inflationary pressures through the rate cuts? The lesson is the US, Eurozone, Japan and Brazil all illustrate the complex interplay between monetary policy and inflation. Policymakers must carefully monitor inflationary trends and avoid excessive easing that risks overheating the economy. The third objective which Fed had kept in mind was boosting business confidence. The outcome has been limited. Despite the Fed's rate cuts, the US business confidence saw only modest improvements. Capital investment in technology grew by 2%, but sectors like manufacturing and retail lagged behind. Global trade tensions and policy uncertainty continued to dampen the optimism, limiting the full impact of the Fed's action. Let's look at examples in other economies. South Africa, for an example. In South Africa, despite lowering the repo rate to 3.5%, real business investment declined by 5%, while unemployment reached 32.9%. The combination of political instability and structural economic issues prevented monetary easing from delivering its intended results. Japan's long-standing experiment with low interest rates has also done little to boost business investment. Despite having near zero rates for decades, Japan's private sector investment grew by only 0.5% last year, showing the limits of relying solely on monetary easing to stimulate business activity. The lessons from the third objective are clear. The experiences of the US, South Africa and Japan demonstrate that interest rate cuts alone cannot substantially improve business confidence. Structural reforms such as enhancing infrastructure, political stability, and market conditions are essential for long-term growth. The fourth objective which Fed had kept in mind was managing currency and trade dynamics. The outcome has been mixed. The Fed's rate cut led to a 2.3% depreciation of the US dollar, which boosted export volumes by 3%. However, this also resulted in higher import prices, adding to inflationary pressures. Furthermore, the dollar's decline triggered capital outflows from emerging markets as investors sought higher returns elsewhere, increasing volatility in global markets. China's example is worth looking at. China, in contrast, has cautiously managed its currency while keeping rates relatively stable. This has allowed China to maintain export competitiveness without triggering excessive inflation. Despite slower economic growth, China has been able to prevent large-scale capital flight, a key risk facing other emerging markets. Experience of India and Brazil in this aspect is also important to see. India's currency depreciated by 4%, boosting exports by 7%, but also exacerbating inflation. Brazil faced a similar challenge with a 5.2% rise in exports, but an accompanying surge in inflation due to higher import costs, highlighting the trade-offs of currency depreciation following rate cuts. The lesson from the fourth objective is the US, India, and Brazil show that while rate cuts can stimulate exports by weakening the currency, this often leads to inflationary pressures and can destabilize capital markets. Countries must strike a balance between currency competitiveness and inflation control. What are the lessons which the global policymakers derive from the above four objectives, their outcomes, and the examples resting elsewhere in the world economies? The first lesson is monetary policy alone isn't enough. The experience of US, India, and South Africa shows that while rate cuts can offer temporary relief, they must be paired with broader reforms to address structural issues such as inflation control, infrastructure, and business confidence. The second lesson is inflation risks post the cut. Brazil's inflation surge and the Eurozone's failure to hit inflation targets demonstrate the challenges of managing inflation after rate cuts. The US must stay vigilant to ensure that its stimulus does not lead to uncontrolled inflation. The third lesson is currency depreciation, which is a double-edged sword. As seen in the US, India, and Brazil, weaker currencies may boost exports, but they also carry the risk of higher import costs and inflation. A comprehensive strategy is required, therefore, to manage both trade competitiveness and inflationary pressures. The fourth lesson is global economic interconnectedness and the effect of rate cut. The Fed's actions have ripple effects globally, particularly in emerging markets. Rate cuts in major economies can lead to capital flight from developing countries, destabilizing their economies. Policymakers must consider global impacts when crafting domestic monetary policies. Ladies and gentlemen, in conclusion, a global perspective emerging from monetary easing is necessary to be understood. The US Federal Reserve's rate cut, while beneficial in some areas, has shown that monetary policy alone cannot solve deep-seated economic issues. The US, alongside other economies like India, Brazil, South Africa, and developed economies like Japan and Eurozone, underscores that rate cuts must be supported by structural reforms to have lasting effects. The experiences of these countries reveal that inflation control, business confidence, and currency management are essential components in ensuring that monetary easing delivers its intended benefits. Global policymakers must therefore adopt a multifaceted approach that harmonizes immediate monetary policy responses with the enduring necessity of sustainable structural economic reforms. This dual strategy would not only address the urgent needs of today, but shall also lay the foundation for a more resilient and equitable growth in times to come, thereby ensuring that economies not only survive but thrive, benefiting all layers of society in every nation in this deeply interconnected and interdependent world. Good luck, best wishes, and thanks for